the COT evidence for gold declining these past few weeks, which I warned about in the previous two silver reports. I was uncomfortable about the commitment of traders reports here, especially the number of shorts held by the bullion banks. I still think there could be some whipsawing action in the days, maybe a week or two ahead. Just stay cautious here and expect it and play nice.
Today, we're diving into an exciting analysis by the renowned market expert Rafi Farber. Get ready to uncover the hidden trends and powerful forces driving the gold and silver markets right now. We'll break down the latest data from the Commitment of Traders COT reports and explore what it all means for the future of these precious metals. Are central banks manipulating the market? Are we on the brink of a major price surge? Rafi's insights might just surprise you. Whether you're a seasoned investor or just curious about the glittering world of gold and silver, this video is packed with valuable information and eye-opening predictions. So, stay tuned as we reveal the secrets behind the metal markets and what you need to know to stay ahead of the curve.
Gold and silver took a dive, as I have been warning about for the last two silver reports. Open interest was way too high for my comfort, and the COTs were showing that bullion banks were record short. That could have been covered the last few days, at least to some degree, but I don't think it's over yet. I think we have a few more weeks of this. Again, this shouldn't really matter for stackers that much because premiums will even out the costs. But for traders, you want to keep being careful here. But in the bigger picture of things, we have an imminent yield curve uninversion. And each recession since 2000, I think even before, I think 1990, since 1990, each recession has occurred after an uninversion of the yield curve. We could uninvert in the next few weeks on the 10-year minus 2-year. And despite the beating that gold and silver took this week, the monetary metals are still climbing relative to other commodities. So it's not just gold and silver that have been hit. It's all commodities broadly, not every single commodity, but commodities in a broad sense have been hit, which is a sign of deflationary forces. And we keep getting closer and closer to the next banking crisis, as we can see on the SOFR, Security Overnight Financing Rate, the volume of which just keeps going up, and the rate is hovering above what it should be comfortably for the Fed. What I'm going to show you guys is that we look to be near or imminent at a yield curve uninversion. This is the 10-year Treasury minus the 2-year Treasury. I'm not quite sure how important this is right now because the 10-year minus 3-month Treasury is still a little bit farther away from inverting, but we'll see what happens here. According to this chart, at least after the yield curve uninverts, meaning after 10-year Treasuries become higher yielding than 2-year Treasuries, we have just a few months until the next crisis. This is exactly what happened here. On the eve of the 2008 financial crisis, we saw the yield curve uninvert and head higher, which really just meant that 10-year yields were heading higher than 2-year yields on a relative basis. It happened over here in 2000. It happened over here in 1990. It's probably going to happen again, probably not in the same exact way. You can even argue it happened over here. This is a 2019 very brief inversion over here, and then headed higher, and then we had the whole, crisis that we shall never mention here in bad words, but everybody knows what it was. I think China was involved. So we just took a little lurch higher in the yield curve spread. And once we cross zero and head higher to a more positive territory, that would signal the next financial crisis. And what happens then, of course, is that everything goes down, including gold and silver. Then the Fed prints, and then gold and silver go crazy, and silver the craziest, and other commodities less so, but they also go up. And that is when gold and silver gain the most purchasing power during financial crises, even though in dollar terms, it certainly doesn't feel that way. That is the reality. We're headed back into absolute deflation. We could be there already. If we look at the weekly money supply numbers that come out every month from the Fed, from the Fed charts, if we calculate the 13-week average annualized quarterly money supply growth rate, we are back to below 1% annual. You can see here that we are about to cross below the 0% line. This is the absolute deflation line, meaning on a quarterly annualized basis, money supply is heading down, and we are heading down again. We briefly broke the deflation plane over here in late 2023. I think it was December 2023. and we've been very low above it since, but we're headed back down into absolute deflation, which means we are headed back into another piece of evidence. The next financial crisis should come pretty soon.
Farber discusses the concept of the yield curve uninverting, which occurs when long-term interest rates rise relative to short-term rates. He highlights the 10-year Treasury Gibber 2-year Treasury spread as a key indicator. Historical patterns. Farber notes that after the Gibber curve uninverts, a financial crisis often follows within a few months. He references occurrences in 2008 and 2019, suggesting a similar pattern could be emerging. He implies that a yield curve uninversion signals a potential downturn in financial markets, including a decline in asset prices like gold and silver initially. Farber emphasizes that while these assets may initially decline during a crisis, they typically surge afterward as the Fed responds with monetary stimulus. Farber's analysis suggests a cyclical view of financial crises and asset price responses, with a specific focus on precious metals. He highlights the importance of timing, particularly noting that gold and silver typically gain purchasing power after and jabber decline during crises. Farber shifts focus to the potential for absolute deflation, characterized by a decline in the money supply. He uses the 13-week average annualized quarterly money supply growth rate as an indicator, noting that it's approaching zero, which signifies deflation. He references the 2008 financial crisis and the 2020 COVID-19 pandemic as significant events that led to substantial increases in the money supply. However, he contrasts these with the current environment, where the money supply has been relatively flat or even declining since the Federal Reserve began raising interest rates. Farber suggests that a return to absolute deflation could be imminent, which he associates with another looming financial crisis. He expresses concern that the decline in money supply gibber could indicate deeper economic issues. The mention of a potential delay in data indicates that the actual economic situation could be more severe than current figures suggest.
I'm going to go into here the COT evidence for gold declining these past few weeks, which I warned about in the previous two silver reports. I was uncomfortable about the commitment of traders reports here, especially the number of shorts held by the bullion banks. It was at a record high, meaning a record negative number here. This is the negative number, means a net short position. It was about 250,000 contracts short, which has never been held before. You see here that we had a record short position in 2022, it looks like. Yeah, this was March 7th, 2022, during the nickel Armageddon fiasco. And that was a long-term, medium-term top in gold here. We had the same record short position over here. At that time, a record short position in 2020, just prior to the unnameable crisis that we shall not talk about. And this little bump over here, this little inversion, this little V, that was the March 2020 COVID crash that freaked everybody out and brought gold down to 1450 and silver down to like 1150 or 1110 or something like that. And it hit a lot of people out of the game who were leveraged, and you don't want to go through that. But, on this long-term chart, it doesn't look like anything, but it was pretty big at the time. Back here, the previous record in bullion bank short positions at that point was during the 2016 high after the initial move out of the 4-year gold bear market. Again, it was a record short position in bullion banks. And we had the same over here in 2015. Another little local high over here. So judging from history and looking at the record short positions in bullion banks, it wasn't very safe over here. And we've got to lower these numbers before we can go on another trip higher. Well, I forgot to title this one. But anyway, this is the gold to commodities ratio. I've shown this before. I just wanted to give you an even longer view of what is going on. And we see here that gold keeps climbing relative to other commodities. So its real purchasing power in versus raw commodities is now at 3.325, which is much higher than the 1980 high. And people have asked me, well, what does this matter? It doesn't really affect consumer prices that much, but indeed it does, except it's on a longer lag, because we're talking about raw commodities, which takes a long time for that to filter into the consumer goods sector. And I made a point in my latest Substack that, in my opinion, even if gold is manipulated, which I believe it is to some extent, I don't think that those that are manipulating it are doing a very good job, because if they were very good at manipulating gold and silver, or did it very effectively, then this chart would be going down and not up. Everyone can have their opinions. I could be having tunnel vision on this issue. I'm not married to it. This is just what I think, and you're free to disagree. Point being that if they're manipulating gold down more than other commodities, this would be going down and not up, but it's not. It's going up and not down. Another thing I wanted to show you about this chart is that the two biggest moves we've seen in gold versus other commodities were during the 2008 financial crisis right here, where it went from 1.5 to 3, a doubling in a few months, which was pretty similar to what it did in the late 1970s to 1980. That was about a tripling, even more than a tripling. So it wasn't as big as the 1980 move, but it was pretty significant. The other major move was during this financial crisis in 2020, where we hit a high of about 5.25 or whatever that is. And this bear market, from the peak of the lockdown crisis until about 2022, was a much worse bear market than the 2011 to 2015 bear market, which was around here, which was bad, but nowhere near as bad as this one. But in dollar terms, it was worse. So just keep in mind this chart for a bigger perspective, I'd say, or a more balanced perspective as to what is happening in gold versus the commodity space, which is, I think, much more important than gold in dollar terms. The last chart that I wanted to show you is that we keep moving higher and higher and higher, including this week where we made a new record high in secured overnight financing rate. This is the repo volume, how much dollars are being transacted every night between banks. It goes up and up and up because funding necessities for big banks keep going higher and higher and higher. And remember, these dollars are not being taken from nowhere. They're being taken from bank reserves. And the more bank reserves they take, the less bank reserves are available for other things. And once they run out, this rate is going to spike up, just like it did in 2019 over here. And we're going to trigger another banking crisis. It's going to come from here. I don't know if it's going to start here or this is going to be somewhere in the middle of the crisis, but it is coming. And this volume is not going to go down, because as the monetary base shrinks and the Fed continues its quantitative tightening, banks will need more and more of these dollars to fund their overnight needs. Yeah, gold and silver are going to go up and down and up and down, and they're going to trend higher until we get to the next financial crisis, which, just like 2008 and just like 2020, changed the entire picture and brought us to a new range. Except this time, I don't think it's going to be a new range. This time, I think it's going to be the collapse of the banking system once the next round of printing starts. We see it in the yield curve. We see it in the secured overnight financing rate, in the repo rate. We might be seeing it in the stocks now, with the NASDAQ taking a nosedive over the last few weeks. But no matter which chart you read, we know that the dollar base is shrinking, quantitative tightening continues, overnight funding needs increase, and that is a recipe for a financial disaster.
Farber highlights the gold to commodities ratio, which measures gold's purchasing power jabber to other raw materials. At 3.325, it's significantly higher than the 1980 peak, indicating gold's gibber power. Despite potential manipulation, this ratio is rising, suggesting that effective manipulation would cause a decline instead. Historical trends show that during financial crises, like 2008 and 2020, purchasing power increases. Farber also notes the record-high secured overnight financing rate SOFR, signaling rising financial instability and potential for a new crisis. Gibber recent gold price drops. Its strong performance relative to commodities is seen as promising for long-term investors. Farber anticipates gold will rebound as economic conditions and monetary policies evolve.